Good morning, students. Our first lesson starts with Introduction to Accounting. Learning objectives enable you to understand the meaning and functions of accounting, analyze the importance of accounting, understand the basic accounting terminologies, analyze the role of an accountant. Every individual performs some kind of economic activity. A salaried person gets salary and spends to buy provisions and clothing for children's education, construction of house, etc. A sports club formed by a group of individuals, a business run by an individual or a group of individuals, a local authority like Calcutta Municipal Corporation, Delhi Development Authority, governments, either central or state, all are carrying some kind of economic activities. Not necessarily all the economic activities are run for any individual benefit. Such economic activities may create social benefit, that is, benefit for the public at large. Anyway, such economic activities are performed through transactions and events. Transaction is used to mean a business performance of an act, an agreement, while event is used to mean a happening as a consequence of transactions, a result. A municipal corporation got government grant rupees 500 lakhs for adult education. It spent rupees 250 lakhs for purchasing literacy kits, paid rupees 200 lakhs to the tutors, and is left with the balance of rupees 50 lakhs. These are transactions and events. Similarly, the central government raised money through taxes, paid salaries to the employees, and spent on various developmental activities. Whenever receipts of the government are more than expenses, it has surplus. But if expenses are more than receipts, it runs in deficit. Here, raising money through various sources can be termed as transaction and surplus or deficit at the end of the accounting year can be termed as an event. So, everybody wants to keep records of all transactions and events and to have adequate information about the economic activity as an aid to decision making. Accounting discipline has been developed to serve this purpose as it deals with the measurement of economic activities involving inflow and outflow of economic resources, which helps to develop useful information for decision making process. Accounting has universal application for recording transactions and events and presenting suitable information to aid decision making regarding any type of economic activity ranging from a family function to functions of the national government. The growth of accounting discipline is closely associated with the development of the business world. Thus, to understand accounting as a field of study for universal application, it is best identified with recording of business transactions and communication of financial information about business enterprises to facilitate decision making. The aim of accounting is to meet the information needs of the rational and sound decision makers and thus called language of business. Evolution of accounting. In its oldest form, accounting aided the stewards to discharge their stewardship function. The wealthy men employed stewards to manage their property. The stewards in turn rendered an account periodically of their stewardship. This stewardship accounting was the root of financial accounting system. The presently followed system of double entry bookkeeping has been developed only in the 15th century. However, historians found records of debit and credit dating back to the 12th century. Although double entry system was followed, stewardship accounting served the purpose of businessmen and wealthy persons at that time. In India too, stewardship accounting was prevalent till the emergence of large scale enterprises in the form of public limited companies. Accounting is a versatile system which serves a large number of purposes in the modern business world. Hence, the following terminologies need to be understood. First one, transaction, an activity which involves transfer of money or money's worth, that is, goods, services, and ideas from one person to another. Cash transaction. It is a transaction which involves immediate cash receipt or immediate cash payment. Credit transaction. It is a transaction in which cash is not received or paid immediately but will be received or paid later. Account. It is a basic unit for measurement in accounting. It is used for identifying a person or an item in accounting. An account is opened individually for a person, asset, expense, income, etc. In ledger, an account is a summary of transactions under a head. Capital. It is the amount invested by the owner or proprietor in an organization. Drawings. It is the amount of cash or value of goods, assets, etc. withdrawn from the business by the owner for the personal use of the owner. Voucher. Any written or printed document in support of a business transaction is called voucher. Examples: cash receipt, invoice, cash memo, bank pay-in slip, etc. Invoice. It is a statement prepared by a seller of goods to be sent to the buyer. It shows details of quantity, price, value, etc. of the goods and any discount given, finally showing the net amount payable by the buyer. Goods. It includes articles, things or commodities in which a business is dealing with. Example: furniture will be goods for those who deal in furniture. Purchases. Buying of goods with the intention of resale is called purchases. Purchases return or returns outward. When goods bought are returned to the suppliers, it is known as purchases returns or returns outward. Sales. When goods meant for resale are sold, it is called sales. Sales return or returns inward. When goods sold are returned by the customers, it is called as sales returns or returns inward. Stock. Unsold goods lying in a business on a particular date are known as stock. Income. It is the amount receivable or realized from sale of goods and earnings from interest, dividend, commission, etc. Expense. It is the amount incurred in order to produce and sell the goods and services. Solvency. Solvency is the capability of a person or an enterprise to pay the debts. Insolvency. Insolvency is the incapability of a person or an enterprise to pay the debts. Asset. Any physical thing or right owned that has a monetary value is called asset. Liability, it refers to the financial obligation of the business. Debtor, a person who receives a benefit without giving money or money's worth immediately, but liable to pay in future or in due course of time. Creditor, a person who gives a benefit without receiving money or money's worth immediately, but to claim in future. Depreciation, it refers to the gradual reduction in the value of fixed assets due to usage and passage of time. Bad debts, it is a loss to the business arising out of failure of a debtor to pay the dues. It is irrecoverable debt. Objectives of accounting. The objectives of accounting can be given as follows. First one, systematic recording of transactions. Basic objective of accounting is to systematically record the financial aspects of business transactions, that is bookkeeping. These recorded transactions are later on classified and summarized logically for the preparation of financial statements and for their analysis and interpretation. Next one, ascertainment of results of above recorded transactions. Accountant prepares profit and loss account to know the results of the business operations for a particular period of time. If revenue exceed expenses, then it is said that business is running profitably. But if expenses exceed revenue, then it can be said that business is running under loss. The profit and loss account helps the management and different stakeholders in taking rational decisions. For example, if business is not proved to be remunerative or profitable, the cause of such a state of affair can be investigated by the management for taking remedial steps. Third one, ascertainment of the financial position of the business. Businessman is not only interested in knowing the results of the business in terms of profit or loss for a particular period, but is also anxious to know that what he owes, that is liability, to the outsiders, and what he owns, that is assets, on a certain date. To know this, accountant prepares a financial position statement popularly known as balance sheet. The balance sheet is a statement of assets and liabilities of the business at a particular point of time and helps in ascertaining the financial health of the business. Next one, providing information to the users for rational decision making. Accounting as a language of business communicates the financial results of an enterprise to various stakeholders by means of financial statements. Accounting aims to meet the information needs of the decision makers and helps them in rational decision making. Next one, to know the solvency position. By preparing the balance sheet, the management not only reveals what is owned and owed by the enterprise, but also it gives the information regarding concern's ability to meet its liabilities in the short run and also in the long run, as and when they fall due.